I'm hoping we can get your thoughts on the markets and maybe a few other things as we're watching. Okay. You just heard Brian talk about how this has been the strongest August we've seen in more than 30 years, 36 years so far. I just wonder how you feel about things, because I know that in July you were a little nervous about how high the markets had been, especially given what's been happening in the economy. What do you think now, because we've only kind of gone up since then?
I'm still a little nervous. Obviously, the Fed's action or the statement recently last week made it clear that the Fed is going to be very accommodative for a while, and that might be fueling the markets for a while. And right now, I think neither party is saying things that's scaring the market. Neither the Democratic Party or the Republican Party is saying things that is going to scare the market. So I think the market has somewhere more to go. But on the other hand, I don't think it can keep going up forever at this pace. I think there will be a pause at some point.
You think neither party is saying anything that would scare the markets? You think if there are things that they should be saying that would maybe be a reflection that would cause concern in the markets?
Well, at some point after the election, whoever wins, I think reality will set in, and we'll have to deal with the deficit and the debt and probably the need for some taxes somewhere to pay for some of the debt and deficit that we have. Nobody wants to focus on that now, and if I were a candidate, I wouldn't focus on it either. But at some point, we can't keep having half of our budget come from borrowing money. I think at some point we'll have to pay some of this down, and at some point we'll probably have to pay for it with greater taxes.
You know, the thing the Fed said last week that caught me the most is just this idea that they're going to be looking for inflation that's greater than they've been looking for in the past. And when that happens, your money is worth less unless you do something like invest it in the market. It seems like a difficult time to not be putting money to work in stocks if you realize if it's sitting in the bank, it's going to be worth less every day.
Well, I worked in the Carter White House, and I know a lot about inflation. We had very high double-digit inflation then, and we're not likely to have that again, because the world economy's changed dramatically. The Fed would love to have 3% and 4% inflation. That's very difficult to do. I think right now the markets are convinced that the Fed is doing everything it can to accommodate the markets. And remember, the central bank's purpose in life generally is to make currencies work and to avoid inflation. In the last 30 or 40 years or so, central banks around the world have taken on the additional job of worrying about unemployment. And that's in our law as well. Under the laws passed in the late 1970s, the Fed is supposed to worry about unemployment as well. So that's another factor, and inflation isn't the only factor they worry about. But it's clear they would like more inflation. They just don't know how to really get it right now.
David, in terms of private equity, when you see the markets at these incredibly high levels, my guess is it makes it much more complicated for anybody in private equity to get out there and say, okay, we're going to buy this company, turn it around, fix it up, and then be able to sell it back for more down the road. What does this do to private equity overall? Is it a good time to be bringing some of the businesses you already have in your portfolio back to market? Is it difficult to try and find new companies that you want to jump into?
Well, it's obviously a good time to sell, and a lot of things are being sold at reasonably good prices. In the old days, we would buy things at 7, 8, 9 times cash flow. Now, if you're going to buy things, you have to pay 10, 11, 12, 13 times cash flow or more. And you can do so in part because interest rates are so low and you can borrow very cheaply. But there's no doubt that the markets are ebullient. And right now, people aren't afraid of paying higher prices. At some point, when the markets go down, I think people will be a little bit more afraid. But right now, it's been pretty good for private equity because we have a fair amount of capital to deploy, and investors are looking for good returns. And private equity over the last 5, 10, 15, and 20 years has probably produced greater rates of return than any other asset class, and it appears that it will continue to do so. So that's why private equity is still a pretty good bet, even though returns may come down slightly from where they were a few years ago.
Are there certain sectors or certain geographies where there are better opportunities than you might see in some of the main things that we continue to look at?
Well, of course, technology is everybody's favorite thing today, and everybody wants to make every deal a technology deal, and maybe every deal is a technology deal in some respect. Healthcare is another very important area that you're seeing a lot of money go into, biotech related to biotech and healthcare services. But generally, I think people are looking for things that are post-COVID. You can see the world is changing. In other words, post-COVID, there are going to be opportunities because people are going to change their lifestyles, going to change the way they work, the way they live, and people are trying to make guesses now about what is going to happen after we kind of get a vaccine and we go back to work. We are going to change our life. Remember, just in 1 year, we've changed our life dramatically, probably more so than we did in any 10 or 20 or 30-year period before because of what COVID has done to make people work at home and work remotely. And so people are going to take advantage of this, and private equity will look for good ways to invest in that area.